This week was another wild one, and let's just get it out of the way right now. AI. Okay, we've said it. We can move on. Let's take a look at the moves that I made in my portfolios this week and where we're headed from here. This week's winner was obviously Nvidia, which popped 24.58% on the back of its earnings report. Going into earnings, everyone, including me, thought there was no way Nvidia could surprise to the upside. In fact, everybody thought Nvidia was going to sell off. Instead, they came out and reported that they were going to have 60% more revenue going forward than even the highest predictions for the market. This proves that artificial intelligence is here to stay, and Nvidia probably has more to go from here, even though it is already up 172.06% year to date. This week's loser is Canopy Growth Corporation, and as I said a few weeks ago, if Canopy Growth broke $1 a share, it's possible that it would sell off very quickly, because that's typically what happens. And that's what happened here. The struggling cannabis maker has dropped another 19.51%, hitting a low of 80 cents a share. At this point, I feel certain that there is a reverse split coming in Canopy's future. If a stock stays under $1 a share for too long, in order to maintain its listing on any of the major exchanges, it needs to increase its share price. Obviously, the best way for Canopy to do this would be for it to increase earnings, but since that's really not a possibility, the only other alternative is a reverse split. In other words, you get 1 share for every 10 shares you have, and then the price goes up by 10x. If Canopy did a 1 for 10 split, we'd be looking at a share price of about $8.60. But it really does look like Canopy has no future going forward unless there's a legalization of cannabis. And at this point, the company is running out of money so fast, bankruptcy might come before legalization does. This week's winner was another artificial intelligence play, but this one wasn't Nvidia. It was AMD, which gained 20.04% on the back of Nvidia's report. AMD doesn't currently have a good AI chip. However, thanks to a partnership with Microsoft, AMD is developing one. And it's possible that it could come out with one that's relatively competitive. I had someone tell me on Twitter that AMD is going to beat Nvidia because Nvidia's been the leader for so long. Guys, this isn't a Disney movie. There are no promises that the underdog is ever going to beat the current leader. You can always say that there are leaders in the space like Research in Motion, which made the BlackBerry phone and got beaten by Apple, but that doesn't necessarily mean it's going to happen. In fact, if you bet on the underdog, you're not investing, you're gambling. You should always pick the company that has the best track record, because that's probably what's going to happen in the future. If you're looking at athletic apparel, you bet on Nike, not Under Armour. No one has ever beaten Nike since the 1960s, and many have tried. However, I do hold a position in AMD because its processing units are better than Intel's, and it's possible that it could come out with a competitive AI chip. So it is a good play on AI going forward. But if you want the pure play, you go with Nvidia, not AMD. This week's loser was Virgin Galactic, which dropped 22.48% this week, despite the fact they had a very successful test launch. In fact, that was the last test launch before they get to start commercial flights, which are expected to start next month. So this was just kind of a sell the news event. Everybody was buying Virgin Galactic going into the launch, and then once it happened, everybody bailed out. My position in Virgin Galactic has long since had the capital and some profits removed, so I just hold it as a lottery ticket on space travel. I'll put profits back in, but I will never put capital here. It is a very volatile space, and we have no real idea of whether or not Virgin Galactic will survive that long. This week, I opened a new position in Chevron with the ticker symbol CVX. Longtime readers of my blog may know that I had a position in Chevron that I started in the sell-off of March 2020, buying it all the way down into the 50s. However, I sold that position earlier this year when Chevron started to get toppy right around $180, and it's since pulled back a little bit over 10%. Since it performed so well on my speculation and play portfolio, I decided to open up a real position in it in the pandemic portfolio. Chevron is a massive energy company, and although it's primarily focused on oil and gas, it is developing renewable energies. Additionally, over the past 10 years, these oil companies have gotten their finances under control, so not only are they stable companies, they also pay really good dividends. In fact, even at these levels, Chevron's dividend is over 3.9%. Now, a lot of people might say that oil and gas is dead, and that might be true, but we're not going to be able to wean ourselves entirely off of it for at least 20 years. And during that time, companies like Chevron and Exxon are going to pivot. You can count on that. Additionally, there isn't enough production. In fact, oil experts believe that we're going to have a supply crunch coming in the next 12 to 18 months because we can't produce enough oil for the demand we're about to see. I opened my position on May 22nd at $152.25 a share, and I started with a really small amount. In fact, only 5% of the total allocation I want of Chevron. Given all the market volatility, there's no reason for me to go in big. I'm a long-term investor, and if it never comes back down to this price, I have no problem buying at higher levels. But I believe we could see a bit more of a sell-off, so I don't want to go in big right now. From here, my next buy target is at $140.55, a past point of support, and I'll keep adding all the way down. Like I said, Chevron was at $51.63 at the bottom in March 2020. There's no guarantee it'll ever get that low again. It's highly unlikely. But you have to keep that in mind. It's only been 3 years since it was that low. I took profits in Nvidia this week in after-hours trading, making a sale with a limit order at $374.79. Now, one of my rules is that I don't use after-hours trading. It's extremely volatile, and you can often do better if you just wait. And I could have waited and done better and made a couple percent more. But I saw the big pop in after-hours, and I wanted to make sure to take some profits in case it did sell off, which it didn't. So my rule's back in place. No more after-hours trading for me. I just can't do it. This sale locked in 2,291.77% in gains on shares that I bought for $15.67 on September 6th of 2016 when I initially opened the position. It lowered my per share cost $29.25 from negative $97.65 to negative $126.90. A negative price means that I've taken all the original capital out, in addition to $126.90 per share of the shares that I still hold, and Nvidia is currently the biggest position in my portfolio by a large margin. From here, I do have plans to make another sale at $443.18, a price that I calculated using the Fibonacci method. Even though there are price targets of $600, this is one of the ones where you have to peel as it goes up because it is way too much of the portfolio in size. My next buy target is at $234.15, and even though that's nearly 40% lower from here, since Nvidia does sell off 35 to 50%, there are no guarantees that those kind of moves are gone from its past and future. I have to plan for that contingency. If Nvidia just keeps going higher, I have what I have. I have a huge position and I don't need to add to it. I do not need to FOMO into this one. It has exploded to the upside and is overvalued by every fundamental metric. With the S&P 500 up over 1.3% and the Nasdaq up over 2% on Friday alone, it made it so that my inverse ETF, the QID, that bets on the opposite of the QQQ, continued to sell off. This is my short position. I'm going to keep adding to it. It's very small and it's not even going to hedge the big portfolios that I hold, but it's fun to have a short when the markets are getting this kind of frothy. I added to it again on the 25th at $15.80, and this buy lowered my per share cost 1.35% from $18.55 down to $18.30. You can see QID is already approaching my next buy target at $14.70, where I will continue adding to it. And I will sell at $18.80 to take some off the table if we see it bounce to that point of resistance. If you do decide to short the markets, make sure you do it with a very small quantity of money that you're willing to lose in its entirety. It's always possible that the markets can go much higher longer than you'd expect. To learn more about long-term investing and to follow along with all the plays in all of my portfolios, you can check out my website, getirk.com, which is always 100% free. Please hit like and subscribe. It really does help the channel out. And I'll see you in the next video.